All right, let's just get right into it. The entire global economic map is being redrawn right before our very eyes. And that means the old rules for investing, they're becoming obsolete. So today, we're building a brand new playbook for a world that's constantly changing. One where huge opportunity and hidden danger are, well, they're two sides of the very same coin. Let's get started. So here's the question you really have to ask yourself right now. Seriously. Because the tectonic plates of the global economy are shifting in a big, big way. We're moving from an era of cooperation to one of intense competition. And what worked for your portfolio for the last 30 years, it just might be a recipe for disaster in the next 10.
For most of our lives, the world kind of operated on this simple premise. Supply chains were getting more integrated, trade was getting freer. Well, that era is over. Done. The new landscape is all about geopolitical tension, trade wars, and a fundamental realignment of global power. Now, does this create massive uncertainty? Absolutely. But for the investor who knows where to look, that uncertainty, that's exactly where the real opportunities are born.
So here's our game plan for today. First, we're going to dive deep into what's being called the Great Decoupling between the US and China. Then, we'll go on a hunt for value in some pretty unexpected places beyond American shores. After that, and this is a big one, we are going to expose a hidden danger, the currency trap that can absolutely sink your returns. Then, we'll build your new global playbook with actual strategies to navigate this new world. And finally, we'll tackle the biggest question of all. What does all of this mean for the future of the US dollar? Okay, first up, the single biggest story in global economics today, this growing rift between the United States and China. And look, this isn't just some political headline you can ignore. It's a fundamental economic split, and it has consequences that are reaching into every corner of the market. This slide right here really gets to the core of the conflict. The US is running a nearly $300 billion trade deficit with China. To put that in perspective, that means we import 3 times more stuff from them than we export to them. That imbalance, it isn't just a number on a spreadsheet. It's the justification for tariffs, it's the fuel for the trade war, and it's the economic battlefield where this whole rivalry is playing out. And no, this is not theoretical. It has very real-world consequences that you're probably already feeling. It starts with tariffs, which make everyday goods like electronics and clothes more expensive. This forces companies to scramble to reroute their global supply chains, causing all sorts of disruptions and, you guessed it, fueling inflation. And here's the irony. Despite all the political talk about bringing jobs back, U.S. manufacturing has actually been shrinking. You add to that the uncertainty of nearly 200 Chinese companies facing delisting from U.S. stock exchanges, and what you get is a perfect storm for market volatility. So with all this chaos centered on the US and China, the smart investor has to be asking, where else should I be looking? And this brings us to the real core idea of this whole explainer, the rise of a new class of what we're calling connector nations. Okay, check this out because this is a really critical disconnect. The US stock market makes up a whopping 60% of the entire world's stock market value. 60%. But the US economy itself, it's only about 25% of global GDP. See the gap? This huge imbalance suggests the US market is not only super concentrated, but it's also one of the most expensive places in the world to invest your money right now. So if the biggest market is also one of the most expensive, where do you find the real bargains? The answer isn't in the old playbook, the BRICS nations. The real growth, the real alpha, it's hiding in these connector nations. We're talking about countries like Mexico, Vietnam, and Poland. They are directly benefiting from this great decoupling as companies rush to move their supply chains out of China. Foreign direct investment is just flooding into these places, and you can get exposure through country-specific ETFs like EWM for Mexico or EPOL for Poland. And this quote just nails the mindset shift you have to make. While all the headlines are screaming about the US-China conflict, the real value is being quietly created in these other countries that are picking up all the new business. Investing in these overlooked markets? Well, that's the ultimate way to exploit pessimism on a massive, countrywide level. But wait, before you rush off to invest in Warsaw or Mexico City, there is a massive, often invisible risk you have to understand. I call it the currency trap. And it is the brutal truth that can absolutely destroy even the best international investment idea. Okay, so here's the bottom line, and you really need to get this. When you invest in another country, you're actually making 2 bets. The obvious one is on the asset itself, the stock, right? But the second hidden bet, the one almost everyone forgets, is on that country's currency. You can be an absolute genius stock picker, pick a winner, but if the local currency collapses against the dollar, you can still lose a fortune. Let's make this crystal clear with an example. Picture this. A US investor takes 1,000 US dollars and converts it into 1,350 Canadian dollars. They don't even buy a stock, they just hold the cash. A year goes by, and let's say the Canadian dollar strengthens to be on par with the US dollar. So what happens? Now, when they convert that 1,350 Canadian dollars back, they get 1,350 US dollars. That's a 35% return without ever touching a stock. It was purely a currency trade. Now, let's flip that scenario around. Imagine you buy a Polish stock and it goes up 20%. You're celebrating, right? But what if during that same time, the Polish zloty falls 30% against the US dollar? Well, you've actually lost 10% on your investment. This is the brutal truth. Currency risk is real, it's powerful, and ignoring it is one of the biggest mistakes you can possibly make in global investing. Okay, so after all that doom and gloom, you're probably asking, how on earth do I navigate this mess? We need a new playbook. And in this section, we're going to cover the essential tools you can use to protect your portfolio. So let's build it out. The first and most critical tool in your new playbook is something called hedging. And honestly, the simplest way to wrap your head around it is to think of it exactly like an insurance policy. Just like you pay a premium for car insurance to protect you against a crash, an investor can pay a small cost to protect their portfolio from a specific financial event, like, say, a currency collapse or a major market downturn. Now, one powerful way to hedge is through something called inverse correlation. Take a look at this. The Dow Jones Industrial Average, well, it moves with the market. When the market goes up, it goes up. Simple. But an inverse Dow ETF is designed to be its exact mirror image. When the market rises, this asset falls. And when the market falls, this asset rises. So why does this matter? Well, because owning an asset like this can act as a kind of financial shock absorber, helping to protect your portfolio when pretty much everything else is going down. All right, finally, let's pull back and look at the really big picture here. All of these shifts we've been talking about, the decoupling, the hunt for new markets, the currency traps, they're all happening against the backdrop of a much, much bigger question. What is the future of the US dollar as the world's go-to reserve currency? You know, for the first time in a long time, we're seeing some real, credible challenges to the dollar's dominance. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, they are actively and explicitly looking for alternatives. And we're already seeing concrete steps. China and Brazil are now settling trades directly in their own currencies, completely bypassing the dollar. Russia is moving its reserves into the Chinese yuan. And there's even serious talk of creating a new common BRICS currency specifically designed to challenge the dollar head-on. But hold on, let's not write the dollar's obituary just yet. It is still the world's #1 safe haven. When a global crisis hits, where does capital flee? It still flees to the US dollar. It has an incredible incumbent advantage. I mean, the entire global financial system is built on dollar plumbing. And yeah, it's shown some weakness recently, but the dollar index is still up over the last 10 years. And maybe most importantly, there is just no clear, stable, and trusted alternative that's ready to take its place on the world stage. At least not yet. So we end right back where we started, with a challenge to you. In this new, fracturing world, just buying stocks in a few different countries isn't enough anymore. That's not true diversification. You have to think like a strategist, considering currency risk, political risk, and supply chain risk. The old definition of a diversified portfolio is broken. The real question is, how are you going to build the new one?